This session is going to be about the voluntary carbon markets. And it's an area that's not been without its controversy over the past year, in fact, over the past few years. Controversies over verification, over permanence, and even the fundamental question about what role avoided emissions or credits for avoided emissions can possibly play in a really net zero world. So we move now into our second panel discussion, which will be moderated by Redshaw. In a previous life of Barclays, when he and I would have worked together on the carbon markets in the early days, but now Chief Executive Officer and founder of Redshaw Advisors. Lewis, come here up on the stage and introduce your panelists. Thank you.
Very good. Thank you, Michael. So thanks very much. I'll stand here for the first bit and I'll go and get a nice comfortable seat in a moment. So I'm Lewis Redshaw. Thank you for the introduction, Michael. And I actually wear two hats. I'm the CEO of Redshaw Advisors Limited, and we help companies understand the risks and liabilities of carbon markets and help them access those markets. But I also run a company called Net Zero Markets, and that company is setting out to try and make the voluntary carbon market simple, accessible, and straightforward. We have a single product called the Global Emission Reduction, the GER. And I'm sure we'll unpack plenty of the complexities of the voluntary carbon market, and you'll understand why I've tried to do that. Now, my background is from compliance carbon markets, and I'm admittedly cautious about the voluntary carbon markets. Now, the legislated carbon markets, the emissions trading markets, they've had plenty of their own problems, and that's with the rules set out fairly clearly in advance for all the participants. So the voluntary carbon market with no guiding legislation at all is subject to difficulties, and it's certainly experienced plenty of them. Nonetheless, the voluntary carbon market is absolutely crucial in the absence of legislation, and that's because emissions that fall outside of emissions trading schemes can't be dealt with. There's no easy way for a company that wants to take care of its carbon footprint that isn't in the ETS to access the market. And access a market, the principle of a market is to have the market decide what the price is by competition between companies to reduce emissions. And so it's not cost effective, or at least that's why we have an emissions trading scheme in the UK and in Europe instead of a tax, a flat tax. It's less cost effective to have everyone forced to reduce their emissions and not have the opportunity to trade them amongst each other. So in the VCM, trust and integrity have been sorely tested. Anyone following headlines in The Guardian this year will certainly know about that. Most corporates just want to do their bit. Few have got the resources, and only some have got the inclination to do all of their own due diligence. And we've got to remember that every dollar spent on advice to try and work out how to do things is a dollar not spent on addressing climate change. Bespoke markets don't scale easily, and we need this market to scale. And it's also, simplicity is key, and that's what investors want too. There's a lot of initiatives underway to help corporates manage their carbon footprints outside of the regulated markets. But the VCM can be a very confusing and often opaque space. With my esteemed panel today, we're going to unravel some of the mystery surrounding the VCM. So joining me today, first and foremost, Julia Hoggett. Julia, if you could join me on stage. Julia is probably well known to all of you, or certainly most of you, CEO of the London Stock Exchange. And she has a wealth of experience in financial markets, including managing a department at the FCA, as well as working at Bank of America Merrill Lynch, JP Morgan, and other banks. Thanks, Julia. We have Paolo Kenewendo. If you could join us on stage, Paolo. Currently the Africa Director and Special Advisor to the UN High-Level Climate Champions team. Boholo has a long CV of achievements, most notably, thank you, as Cabinet Minister of Investment, Trade and Industry, and specially elected Member of Parliament in Botswana. Welcome, Boholo. We have Javier Echave. Javier is the CFO of Heathrow Holdings. Hi, Javier, thank you. Javier oversees Heathrow's £35 billion plan to drive long-term sustainable investment and value generation. Amongst other activities, Javier also co-chairs the European CFO Leadership Network of the Accounting for Sustainability Project. I think I've got that right. And that, the patron of that is His Royal Highness the King Charles III. And finally, remotely, hopefully, we have Annette Nazareth. So Annette joins us from the US. Hi, Annette. So it's looking suitably dark out there with the time difference. She's currently chair of the Integrity Council for the Voluntary Carbon Market. Hereinafter, we're going to refer to that Integrity Council as the ICVCM. And that task, that was formerly the Mark Carney Task Force for scaling the voluntary carbon market. Annette, it's most easy to describe her as a lawyer, but one with a wealth of financial markets experience and expertise, and she has been Commissioner of the US Securities and Exchange Commission, amongst other responsibilities. So I'm going to go and grab a seat, but I'm going to turn to you first, Annette, and I want to ask you, for those in the audience that don't know, what is the ICVCM and why was it formed?
Well, thank you for the opportunity to participate today. I apologize for not being there. Mansion House is such a wonderful place to bring people together and collaborate, so I'm sorry I can't be there with you. The Integrity Council for the Voluntary Carbon Market, which, as you noted, Louis, is the ICVCM, is an independent governance body for the voluntary carbon market, and we aim to ensure that the voluntary carbon market accelerates just transition to 1.5 degrees. Importantly, we do that by establishing a global benchmark for integrity carbon credits. As you suggested, the markets heretofore have not consistently delivered the kind of integrity that we need in order to scale these markets in a manner that will really make a difference in reaching our climate goals. High integrity carbon credits can unlock urgently needed finance that would not otherwise be available to reduce and remove billions of tons of greenhouse gas emissions. Now, as you mentioned, the ICVCM is an outgrowth of the Task Force on Scaling Voluntary Carbon Markets, which was originally stood up by Mark Carney. I was an operating lead in that effort, and Bill Winters from Standard Chartered was the chair. And we spent a year working on a blueprint for what a high integrity carbon market should look like. And the ICVCM was an outgrowth of that. We are now a standing body with 21 board members, 3 members who are from Indigenous peoples and local communities, 3 from the markets, and the rest of us are independent. So we're overwhelmingly independent board members. And we run a very transparent process. I like to say, as you mentioned, I'm a former regulator. We've run a very regulated, compatible process, shall I say. Very transparent, very open. We proposed what we call our core carbon principles, which are the 10 fundamental principles for high quality carbon credits. And those were put out for public consultation, along with the assessment framework to ensure that those principles are actually put in place. The CCPs are designed to create real, verifiable climate impact based on the latest science and best practice. We have worked with stakeholders throughout the voluntary carbon market to build an understanding of what integrity means for carbon credits. And our CCPs and our assessment reflects the experience and insights of hundreds of organizations that have participated in our consultations and also responded in writing to our open consultation. So, as you mentioned, it's really important to have carbon credits that are more standardized, that will make it easier for buyers to identify high integrity credits, no matter which carbon crediting program issued them, or what kinds of credits they are, or where they were generated. So the CCPs and the assessment framework are really designed to reduce confusion about credits and to overcome market fragmentation. As you mentioned, we cannot scale a market that is, as we have today, bilateral. We need much greater standardization. Hopefully, have greater transparency on the transactions, and also the opportunity to trade on transparent trading venues, whether exchanges or ECNs or things of that nature. We have issued our core carbon principles, and we did that in March, and we issued the assessment framework for the carbon crediting programs. We expect to announce our assessment framework for carbon categories sometime by the end. And we hope to be in a position where once we start carbon crediting programs and designating carbon categories for the CCP label, that we could possibly see a CCP issued credits by late in the third quarter of this year, which would be very exciting. I'm delighted to say that the OECD has already said they purchase credits that meet these CCP principles. And again, that is really very exciting, because I do believe that if we ensure integrity, scale will follow, and the voluntary carbon market will to meaningfully contribute to our net zero goals. So I'll stop there for now.
Wonderful. Thanks very much, Annette. And I go straight to you, Javier. So you've included voluntary carbon market carbon credits in your decarbonisation programme. And Annette mentioned some of the difficulties around integrity and confusion in the market. How did you cope with that in the absence of the ICVCM CCPs?
Well, thanks, Luis, and good morning, everyone. So obviously, I think the fundamental key thing is that we are a key user of that market. Heathrow is the only hub airport in the largest aviation market in the world. I think that hopefully many of you today used Heathrow, and hopefully we provided great service. It would be a horrible way of starting my presentation if we miss your back. But I think that it shows really what the power of aviation means. I think aviation is a force for good. I think it delivers 13 out of the 17 United Nations Sustainable Development Goals, enables trade, enables adventure, enables holidays also. But I think I think we have a huge critical role to play. We are the largest port of the UK. The UK is the 5th largest economy of the world, and that's been enabled, being relatively small in size, but a critical independent trading nation. That's been enabled through Heathrow. So we have been decarbonising aviation. 95% of the emissions, of the greenhouse emissions from Heathrow, comes from aircraft burning fossil-based kerosene. And UK and Heathrow itself use half of the jet fuel in the UK. So the opportunity here is that if we fix Heathrow, we can fix aviation. And if we can fix aviation, which is seen as one of the most hard to abate sectors, actually there's no excuses to really demonstrate that actually we can protect the benefits and the prosperity of the markets that we have today, but in a world free of carbon. So in our plans to really decarbonize aviation, we have multiple components. The fundamental thing is to really change the fuel in aircraft. We are doing that by driving efficiency in aircraft. Every single year, aircrafts are delivering more greener technology, but also by changing the motorways in the skies. As we speak, the airspace in the UK is being redeveloped, and that allows injecting technology to really have less usage of fuels. Second is by using sustainable aviation fuels. That technology does exist today. Unfortunately, there's not enough of that, and therefore the challenge here is about the scale and speed, because one of the debates that we keep talking about since COP26 is about urgency. This is not about technology not existing, this is about this, no, we are not acting at the right speed. Third thing is about really using new technologies. So we expect to see in the mid-30s the first commercial aircraft using green hydrogen, and therefore that's going to be transformational. But still there will be a residual amount of emissions that will need, especially the use of VCMs, to really make that happening. I think my job as CFO is I am a big capital markets animal. Sometimes people say more animal than capital markets, but definitely capital markets animal. And I think that one of the things that we do is that we channel global investment with a single goal, to make sure that you have a great service, not only now, but also beyond 2050. And therefore, capital markets money can be a huge force for good. So what we have learned over the last 2 years, COP26 was about really moving from pledges into action. But actually, we are starting to realize that actually executing those options are difficult. And this is where capital markets, VCMs, have a huge role to play. I think at this stage, unfortunately, we cannot do this alone. I think that aviation has the power to really show that demand. When you look at, we will discuss later, I'm sure, about some of the things that is happening today. CORSIA, for example, is a great scheme that will use around 2 to 3 billion credits by 2035. We need a platform to really make that happen. We need a platform connecting the problem with the solution. And it has to be an inclusive, efficient, effective, scalable solution. Markets can do that. Money can be a force for good. Unfortunately, at this stage, we are not there, and we require more policies to really create that trust, that transparency, so we can really scale up the solution. So, Luis, I think it's happening, but unfortunately it's happening slowly. And the key lever to really accelerate that is to use the strength of, among others, the City of London to really role model how that trustworthy financial markets in BCMs could look like.
So, Javier, when we spoke earlier, you mentioned the need to, and you mentioned it again just now, to scale action. Yep. And to do it fast. What would you hope for from the ICVCM to help do that, or indeed the government in terms of setting rules in order to help companies like yours to cope with and increase your climate ambition?
Well, I think first of all is we have to remain owning the problem. I think we have to remain grounded and realizing that actually, yes, aviation is a force for good, but therefore the carbon is the real enemy that we have to really fight here. I mentioned earlier that today, when you look at aviation, IATA was the first global sector in the world to adopt net zero. Airlines use CORSIA as a well-proven mechanism to really reduce the level of emissions. As of today, the objective of CORSIA is primarily carbon neutrality by 2035. But that can be scaled to really transition post-2035 to really adopt net zero at speed. The volume is absolutely massive, and the success is absolutely critical and demonstrable. The fundamental thing is how can governments create the right policies so to the signals of demand that we are driving from aviation can be supporting the right foundations to make it inclusive. It cannot be delivered by the West to the West. It has to include absolutely everyone. Again, it has to be able to connect the sustainability, but also with prosperity, which is one of the failures over the last few years. If we continue facing this apparent dilemma between sustainable and prosperity, we will fail. We can deliver sustainability in a prosperity way. But again, we need the right policies by the market, by the government to really enable those vehicles to really scale up.
Very good. No, thank you very much. So I'm going to bring you in now, Julia, and Javier mentioned the need for a platform. There's been a lot of attention paid to the VCM the last 2 or 3 years. I mean, it really has increased rapidly. not all of it's been positive. So what are the key drivers from your point of view for why the voluntary carbon market is important? And while we're at it, what needs to change for it to be trustworthy, and what does a well-functioning VCM offer that can't be achieved through other means?
Well, I think your introduction illustrated why it's important, actually. Fundamentally, when we were looking at our role in the voluntary carbon markets, we took a step back and looked at the nature of the UK regime. Now, we already have TCFD as mandatory for listed issuers in the UK, and we're increasingly going to have mandatory transition plans as well. And that actually creates the space for the public dialogue about the hard yards that companies are doing to directly decarbonise and where they need to take incremental action. And to me, I think that Javier said it in terms of this oppositional sense of either or, we have to recognise that this is such a pressing challenge. We have to throw absolutely everything at this problem. And we need to make sure that we are giving people routes to invest in the solutions. And that's where the Science Based Targets Initiative has also said that the voluntary carbon markets and investing away from your direct production supply chains is critical to getting to net zero. Now, the question is how you do that in a way that is trusted and scalable. The capital markets, I always say, and I say that our job as London Stock Exchange is as a convener. Our job is to bring together those who have capital with those who need capital in service of an objective. And I've gone on record as saying there is no more important objective for our generation than the just transition to net zero. So the markets have to play a role. And one of the things that we can do is we can create standards, we can create rules, we can create systematization, we can create the trust. But it does mean putting all of those processes in place. And the way that we've approached it at the London Stock Exchange is to take all of the scrutiny and discipline that the public markets present, not wait for regulatory change, because that wasn't going to happen at the pace we wanted to, and build a market that was founded on that.
No, thank you. And so I know that London Stock Exchange Group have been working away to understand the VCM and to bring to market some related initiatives. And of course, you mentioned the need to create a way for investors to be involved more easily than having to become absolute experts in every single facet of the voluntary carbon markets. There's a lot of other organisations trying to do the same thing, and a fair bit of competition amongst exchanges in particular. What can London Stock Exchange Group bring to the party?
Well, we've taken a very different approach, and it started with that first assessment of the market when I joined the exchange. And I describe it as the chicken and egg problem. Because to me, the additionality piece of voluntary carbon credits is critical. And so I always say to everybody, you can't get a voluntary carbon credit from building a wind farm off the north coast of the UK with a viable offtake price, because you do that anyway. And therefore, the confidence to invest in a voluntary carbon credit is the confidence that you get a voluntary carbon credit, kind of credit project, is you get a voluntary carbon credit at the end of it. How do you have the confidence to invest in the projects that generate the voluntary carbon credits without a deep and liquid voluntary carbon market as a reference price? How do you create a deep and liquid voluntary carbon market without a whole load of projects that generate the carbon credits? That, to me, is the chicken and egg issue. Most other venues, if I'm honest, have focused on nickel and diming the efficient trading of the credit. That's fine, but it doesn't solve the problem. We have established a voluntary carbon market where the team that is responsible for it know that they have from me one real-world KPI, which is in 20 years' time, how many tons of carbon have been taken out of the atmosphere that would have been there otherwise if our market hadn't existed. Because that's actually what the market is there to do. And so what we have done is we have taken the standardized transparency and listing and market abuse regime that we have in the UK for operating companies and for funds, and created a designation that references ICVM and references ACROA and says that this is how you get the designation to be an asset on our market that is a freely tradable asset that requires the transparency regime, the listing regime, and the market abuse regime to be fully followed. And therefore, a corporate can invest in that asset as a freely tradable asset that will give them a forward flow of voluntary carbon credits, because the asset, the fund or the company, can pay a dividend in specie as voluntary carbon credits. So if you are a listed issuer and you've got TCFD disclosure and you've also got a transition plan, you can say, I have invested in this flow of assets that will is expected to generate me this flow of credits, and this is therefore how the entire project fits together. Now, the benefit of that is there's a lot of unknowns in this. We don't know, and no company will exactly know how many carbon credits they're going to need. because they're not going to know the exact value and success they're going to have in all of their direct decarbonisation activities. So much better to buy something that is liquid, that you can sell, or that you can buy more of, than something that is fixed. So you're taking all of the values of a transparent public market and making sure that it's wrapped around the structures that are needed for the voluntary carbon markets. And for us, we've had our first designation already. We're seeing what I had hoped for, but I didn't dream of, which is actually the development right now of funds at scale, at serious scale, to put money into these projects and into these markets. And to me, the issue is, we have sometimes in our debate about the transition to net zero made the perfect the enemy of the good. And I think the global north is often guilty of that. We have created standards that it's actually very hard for quite a lot of companies that are doing really good work in the global south to meet. Now, if we create the choking off of the financing into the global south, it's on us, because we created the pollution in the first place that triggers us all to have to move on this global pace. So I do think that one of the other things we need to do is create that standardization and structure, but create the capacity to innovate, evolve, and learn, and fail fast and correct, and not assume that everybody sitting in a conference room right now knows every single route we have to take to get to net zero. Because my other view is that if getting to net zero was easy, we'd have done it already. And markets like systematization, they like standardization, they like absolute certainties. And we need to create a system that can adapt and learn and is genuinely globally inclusive. So I hope some of the biggest foundational investors in these funds are the sovereign wealth funds in the global south who can actually be the providers of the assets for this. Because that is the way of actually sharing the value. And I'll finish on one point, because I can rant on about this for a very long time. As you can tell, it's a passion project of mine. Fundamentally, I want, for the sake of the planet, us to compete on quality, not price, for voluntary carbon credits. And the reason we have created a market that is about financing those credits with the wraparound of the disclosure standards and quality that we've sought to create, without needing to wait for the FCA to make any rules, just using the existing market rules we have, is so that we can compete on quality. Because that is fundamentally what will get us to net zero.
Very good. Thank you very much for those comments. And it provides a good segue to you, Baholo. What have we missed out so far in this discussion? I know Julia's started talking about making things perhaps simpler for the Global South to start producing high-quality projects. But from where you're sitting, what else has the VCM got wrong so far?
Well, I think first is why is it that we're doing this in the first place? What is it that's motivating this conversation around carbon markets and the VCMs? And then what is the cost of inaction? And then in the case of nature assets, what is the opportunity cost to having nature assets or not having them? And I feel like quite often the conversation on VCMs, as it should, because we're talking about capital markets, solely focuses on the financial instruments and how companies relate to the financial instruments themselves, without thinking about the fact that we started this for people and planet. And if we're not dealing with the issue of people while we're trying to solve for planet, then we are failing the equation altogether. And as it stands, we have seen an incredible flow of climate finance. We've seen an exponential growth of climate finance, and in particular, within the carbon market space, over 800 billion in compliance markets, over $2 billion in VCM in 2022, and less than 3% of that has gone to the continent. And only about 11% of total offsets that retired carbon that has happened in the last 10 years has been African. And yet, what we know is that the continent is a custodian of 25% of all nature assets that are providing the largest carbon sink in the world. Now, the Congo Basin in itself is providing more than even the Amazon and Indonesia combined, and yet doesn't even come anywhere close to attracting the right financial investment to it compared to those other two. Now, even within the continent, when we're looking at the flow of carbon finance or green finance, the Congo Basin in itself, I'm just going to focus on this little area because I think that's where the real failure of the VCM is in dealing with nature assets. The Congo Basin in itself then only attracts less than 30%, and I'm picking just DRC, less than 30% of the total flows of finance that goes into carbon space in the continent. So there's clearly a big injustice here, and we are failing in the market to respond to exactly what it is that is safeguarding the world, and that is going to be the main contributor to us achieving our long-term goals towards net zero. And so we have to think, often the issue of additionality is brought up on. So my challenge even to VCM and VVBs is usually, so you would rather we cut down the Congo Basin then start to replant for us to have real value. There's a market failure here. If we do not see real commercial value of a standing asset, because the opportunity cost of the Congo Basin, we know it. There's oil underneath the Congo Basin. So if we fail for the market to meet the commercial value, to unlock real value for the Congo Basin, then the countries will be forced to go into oil that the market knows the commercial value for and is responsive to the commercial value. But that's not what we want when we talk to net zero and delivering on net zero. So we have to really rethink our methodologies when it comes to standing nature assets, forests, old growth forests, peatlands, and the mangroves, and really make sure that the instruments we're working with are responsive to that. I know there's a big issue around REDD+ credits, and Vera has issued new standards that they'll be working with and so forth. But we need to take into account that all methodologies initially, and this is quite, people think it's been quite controversial, but I think VCMs were started for European and US-based markets that do not have the carbon sinks that other developing markets have. So we need to adjust because we are not getting the carbon reductions out of Europe and out of the US, but we are getting them elsewhere. So the market and methodologies should respond to that. And then secondly, we have to think much broader than what is it that aviation industry is going to get from the offsets to the complementaries that come with particular carbon projects in the continent. Here we're looking at biodiversity, and then we're looking at the socio-economic benefits. If we just picking up in the clean cooking projects in particular, those ones, they have huge co-benefits. We're talking about over 1 million women that die from health-related issues, from dirty cooking solutions, and we're talking about productivity improving when we invest in that space. So if you invest in clean cooking technologies, you are investing beyond your own offsets, but you're looking at also increasing the conversation around just transition. Because in other parts of the world, what is just transition when you've never even had energy? So I think we need to think much more broadly about what just transition means, how our methodologies respond to capital markets, but also to socio-economic needs. And we have institutions that can take this upon if the challenge to markets is risk perception or that we don't have stable markets. AFC was speaking earlier. They have good credit rating, the AFDB, Afrexim, and I think thinking about how you can also use carbon markets to act as guarantees and climate debt swaps to unlock more financing to drive development in the continent and beyond.
So I think a double irony in relation to your comments about the Congo is that there are methodologies either around or being created to allow fugitive emissions from abandoned oil wells, but there aren't any for the existing nature capital. So
right.
That's a very good point. And before we sat down, we talked a little bit about one of the projects you're working on. And one of the things that's very close to my heart is the barriers to entry to this market, but also what's the best way to describe this? the large markups that can be applied by retailers to corporate offsetters. And one of the solutions to that is to have exchanges operating. But one of the solutions to one of your problems, Boholo, is to have trusted products on trusted platforms whereby the money is going to the projects rather than to intermediaries.
Right.
Tell us a bit more about the project you've got going on there.
Yeah, so we launched the Africa Carbon Markets Initiative last year at COP27 with a good political will from about 6 African presidents and a good partnership from the private sector. I mean, at the time of launch, we had about 5 companies. We had some buyers that wanted to commit $200 million towards African credits, and then 8 countries that wanted to start working on an enabling environment for carbon markets. And then we had several investors that came to play into helping get the projects started from the ground. But the real challenge, as you said, is at the moment we have 3 accreditors in the continent, and that process has been really slow and quite expensive. And then in the end, one of the challenges is that we do not see real value going to the communities, because at the end of it, we are seeing climate finance, carbon finance as a catalyst for development finance. We want to see education being highlighted as an imperative of carbon action and so forth. So SDGs coming together with climate action. So we think that there should be cost disclosures, there should be transparency in how it is that the market operates, where the value really goes, in order for us to go back to the why VCMs got started. And we can see if indeed we are working towards SDGs and achieving those within the VCM and both the compliance markets, by the way. So at the moment where we are with the African Carbon Markets Initiative is we're working with some auctioneers that want to auction African carbon credits. We do not run auctions, but we do facilitate. We've created a pipeline of projects. And then the investors that want to facilitate pre-project development side. And then we have some of our development partners that are facilitating and investing in creating an enabling environment. The challenge at the moment is we are looking at sustainability, we're looking at climate action. Most African countries are financing adaptation and resilience from loans. And so when they think that the VCM space is very vibrant, there's a lot of money that's going to come from this, of course you're going to think about adding an additional tax of 50%, as Tanzania and Zimbabwe are thinking about. And we are trying to dissuade countries from doing that in order to allow the carbon markets to grow within the continent. But in order for that to happen, we need to see investors and private sector players coming to the table with disclosures, transparency, and the willingness to pay real value for the assets that the continent is putting on the table.
That's fantastic, thanks. And I think it's a message that is well understood by the people on our panel, which is great. So I want to ask, I've got a few questions. I'm going to chuck them at individuals to make sure that we don't go over time. So Annette, we've got a whole load of people in the room. There are investors and there are people who are probably interested in corporate offsetting. What would you tell investors in the room to focus on and over what timeline?
I assume you're talking to me because you're
Yes.
looking up. I would say for certain, as has been made very clear on this panel, investors need to look for high integrity credits. And I believe that serious help is on the way in that regard, that by establishing a global threshold standard that will be implemented, investors will be able to know in a much more seamless way what it is that they're buying. And I believe that there actually is a lot of pent-up demand, and that the market is anticipating that these CCP labels will be out in the marketplace by the end of the year. And I would very much encourage investors to look for those labels and to purchase products that have those labels.
Very good. Thank you, Annette. I'm going to throw this one open to all three of you. The first one to look me in the eye can answer the question. What would you like to see from COP28?
Well, I would like to see pragmatism in the sense of we will only succeed if we, in the process of delivering sustainability, we deliver prosperity for everyone. And Hollow, I think that brought to life much better than I can ever do. I think that today there's an acceptable geographic and economic asymmetry between the problems and the solutions. Mm-hmm. But I think that the opportunity is that money and investment can be a force for good. I think BCMs is emerging, but BCMs could be that platform. But I think that platform needs to be evolved, new policies, transparency, robustness, solvency, clearance. There's a lot of principles that actually we have to build on that to really build trust, because trust is absolutely critical to really allow money to flow. So sustainability and prosperity needs to come together. It must be an inclusive, fair, just, effective, efficient, scalable markets really flowing and connecting more effectively solution with problems.
Very good, thank you. With 1 minute left to go, so the VCM in 1 year's time is going to be in a very different space, I suspect, with what we're hearing on the panel tonight, this morning. What would you most like to see happen in the voluntary carbon markets when we get back together next year? Let's go.
Right. I would like to see more fair, equitable methodologies that are representative of the various landscapes that we're living in, and pricing and both quality that is responsive to the assets that we have. A clear definition on what high quality credits are, because I think there's still a large question on what constitutes as high quality and what constitutes as integrity in this space. So I'd like some more clarity on that, and I think everybody in this room can help us reach that. And then that there is a good access and participation reception of foreign credits in compliance markets and in VCMs abroad, where there's better capital in order for us to ensure that there's a more efficient flow of finance across the north and the south.
Thank you, everyone. And Julie's agreed, so I won't ask her. So we're out of time. I would like to ask you to join me in thanking our panelists for their contribution today. So thank you very much, everybody. And